the recording. And on behalf of our team, I'd like to welcome you to our Farm Office Live here, January 13th, 2021 version. We are pleased to be back here in 2021 to bring the Farm Office Live again. Our team is back together. We were able to give 10 of these workshops in 2020, thought the coronavirus pandemic would be over. But of course, we are still lingering through this. So as we are in our virtual world of programming, we are here tonight to offer you some updates, some farm management and ag law updates. Just as a reminder of who will be doing the teaching tonight from left to right across your screen, and we'll be handing off the program to each of us this evening. First is Diane Shoemaker, who's the OSU Extension Field Specialist in Dairy Production Economics. Also know on the slide, if you want to contact us after the program, our emails are there for you. Barry Ward, who's director of the OSU Income Tax Schools and the leader for our Production Business Management Program. And Peggy Hall, their director of the OSU Agriculture and Resource Law Program. And myself, David Marison, the Agriculture and Natural Resources Educator here in Coshocton County. Just a reminder, and Barry has put this in the chat for you, but if you want to get the slides that we are presenting tonight, just go ahead over to go.osu.edu/Farm Office Live. The PowerPoint slides are there, as well as we are recording the session. So if you want to come back, there's something that you missed and you want to hear it again, you can just go there and hit the recording. Now we have two features on this program. One is a chat feature, as well as there's a feature called the Q&A. Now we will be monitoring the Q&A feature. That's where if you have questions during the program, that's where we ask you to submit your questions. There will be time as we'll try to work in as many questions as we can tonight, but I'll be honest with you, we just have a full plate here as far as when you look at the slides. We have a lot of material since it's been since October where we have met. We will try to answer those as many as we can. We'll be answering them on the back side for each other, as well as if you have questions after the program, you can email them directly to any of us. If you want to email them to me, I can get it out to the team as well. And my email there is marison.2@osu.edu. And then at the end of tonight's program, when you exit the Zoom webinar, it will take you to an evaluation screen. And we would just kindly ask if you would answer those few quick questions. Shouldn't take you about 3 minutes to answer those, but when you close out tonight, there's a few questions we just want to have you answer, and that will help us as we plan next month's programs. Of course, we're doing the Farm Office Live tonight. Welcome aboard. If you want to get a repeat of this, we will be doing it live again on Friday, this Friday morning from 10 to 11:30. And with that, again, if you just want to put your Q&A in the Q&A box, we'll answer those questions along the way. But our first presenter will be Peggy Hall. And Peggy, I'm going to let you grab the screen share, and Peggy's going to talk about the Consolidated Appropriations Act of 2021 and the COVID relief funding for the USDA. So Peggy, I'm going to turn it over to you. Welcome, everybody.
All right. Can you see my screen, David? I'm trying to get into...
As long as you'll go into presenter mode.
It won't allow me to, so hold on just a moment. Yeah, I can't access it because of the bar won't go away. Let me hide that. Hold on. Sorry, guys. There we go. All right. All right. So my job is to talk about the USDA appropriations that are in the Consolidated Appropriations Act that was recently passed by Congress. And within that bundle of appropriations, we have a number of COVID relief funding provisions for USDA. So I'm going to fly through those pretty quickly. There's a lot in there and we don't have a lot of details yet, but I can at least tell you what is in the legislation itself. It contains about $11.2 billion in direct assistance payments for farmers. And then there's another around, I think it's 1.8 billion for USDA for other purposes, bringing that total package up to 13 billion for the latest round of COVID relief funding. So I'll cover most of that, and then Diane's going to come in and discuss the dairy provisions that are in there. And probably foremost on everyone's mind would be, when will these payments start? When will they begin? And we've been checking around and asking, and all indications are that they will begin in later after the administration changes. So later in January and thereafter. Now, some of these programs, as you'll see, are going to be brand new. So they're going to require some regulatory action, and those will take longer. But the one that's not brand new is CFAP. CFAP is back for another round. And what the new legislation will do for CFAP in regards to crops is to allocate another $20 per acre for eligible crops from 2020. And those are going to look a lot like CFAP too. So we have those price trigger crops that had the 5% price decline, and that's where most of our Ohio producers will be, in that corn and soybeans and wheat area. Those crops will receive that $20 per acre payment. And then we also have those additional flat rate crops such as alfalfa, some of our small grains, hemp. I'm not sure we have any sugar beets anymore, but they're in there. A number of other crops that will go under that flat rate. Doesn't matter either way, there's a $20 per acre payment for those 2020 crops. And you can see what that translates to. And I'm sure that my co-presenters here are surprised to see that I actually did a graph. I don't know if you guys noticed that. I don't usually get to do graphs as an attorney, but there's my graph that shows where that CFAP 3 money will go. Quite a lot going to corn, beans, and wheat in Ohio and around the country there. So other crop provisions, we have some language in there that says that USDA may look at some price differentiation factors to allow a little bit flexibility there for different commodities such as certified organic or our local markets or specialized varieties. There's also some language authorizing them when it comes to specialty crop payments to include crop insurance indemnities and disaster payments for those specialty crops, either 2019 sales, or they can even substitute 2018 sales when they're looking at those eligible sales for the specialty crops. And that was a concern that many in that category had with round 2. There's another 100 million allocated for the specialty crop block grant program that is intended to specifically address some of the harmful impacts of COVID. So more money going into that program that USDA will have. And then there are also is some interesting language trying to address some of the tensions that we saw around the country with different producers and payment limitations, where they did give USDA authority to make sure that those payments are evenly distributed and additional payments if necessary, that to ensure that up to 80% of loss could be covered in that situation. There's another provision that would allow USDA to extend marketing assistance loans to 12 months. So a lot there for those types of producers. And then when we look over at the livestock and poultry producers, a big issue, as you know, concerned the depopulation of livestock and poultry. And that was due to that processing issue that we saw around the country, not having sufficient processing access. So CFAP 3 will include payments for depopulation losses, and those will be maxed at 80% of fair market value of the animals. And then if there have been state depopulation costs or under other federal programs, those have to be removed from that calculation. So they won't be covering, double covering those reimbursements that have already been made from other sources. We have an additional cattle inventory payment that will be made. And again, that will cover that same April 16th to May 14th period that CFAP 2 covered. And there's a calculation formulas in there. When you work through those formulas, what you end up with is about $63 per head for fed cattle, $25.50 for feeder cattle, And then it goes on, I think around 17 at the base, but those numbers are being worked up right now for those additional cattle inventory payments based on that formula. And then many of you know that our contract growers were relatively left out of some of these previous payments. So there's $1 billion given to USDA to try to address contract growers, and not a lot of detail in this one. And so USDA will have to be working that one out. This is going to come later as they figure out what regulations are necessary to determine those payments to contract growers. The only guidance they have is $1 billion and not more than 80% of revenue losses to be covered by those payments for a grower. We also have $20 million to USDA to boost its animal disease prevention and response, which again is something that's somewhat related to COVID, but has been an ongoing problem. And another ongoing problem that's not just COVID related is the issue of cash sales for livestock dealers. And they used COVID as an opportunity to create a mandatory livestock dealers trust that will hold and ensure payment for those cash sales of livestock. That will apply only to those dealers who have over 100,000 per year in annual purchases. There's also a continuation for mandatory price reporting, kind of skirting around some of the other issues that we've seen there in that livestock arena. That will go till September 30th. And then a lot of attention paid this time to some of the marketing and processing issues that we have suffered as a result of COVID. So there's a $60 million grant program for those smaller, mid-sized facilities that are trying to qualify for federal inspection or to get into the cooperative interstate shipment program that would allow those processors to ship their goods to other states. So a lot of money going into stabilizing and expanding that mid-level processing arena that we've seen disappear over the years. There's also a mandate, basically, that USDA complete a report on the CIS program and other programs that could increase meat and poultry processing capacity. So many are glad to hear that. But again, we're going to have to wait to see what that report says and what recommendations come from that. And then as we look at our local markets and some of the impacts that perhaps were not adequately addressed in previous legislation, we've got $100 million going to the local agriculture market program to examine those and address some of those impacts on local markets. And again, looking at that issue of insufficient processing access and trying to address that. Then a few other items as far as biofuels, there were a lot of concerns about that and the loss in those sales. And so authority given to USDA to make payments, but again, very, very little guidance on this one. And so we're not sure if USDA will use its authority or its funds to address those payments because that didn't come with an item line with the biofuels payments provision that they now have authority to make. There is $300 million, however, allocated for fisheries disaster assistance. I don't know if that will affect any of our folks here in Ohio, but we probably will see some positive impacts for the timber industry in Ohio because $200 billion has been allocated for timber harvesting and hauling businesses if they suffered a loss of 10% or more in gross revenue last year. And then finally, there's money put into rural broadband because so many rural residents had to secure broadband in order to put students to school, maintain their workplaces. And so there will be some subsidization of broadband costs. And then finally, there's another food purchasing program, $1.5 billion allocated for that to both purchase and distribute food out to needy and to help those small and mid-sized processors be able to engage in that. And another review required to, again, examine what can we do better here when we're looking at food purchasing and distribution. And then a couple of other items here, and I'll turn it over to Diane to discuss dairy, but we've got the nutrition incentive program with additional funding, as well as some training for socially disadvantaged and beginning and veteran farmers, $75 million to go into that, and some money to address farm stress at the state level. So 28 million will be given out to states for farm stress assistance programs. So quite a bit in this package, and I know that was a fly through, but Diane, now I'll turn it over to you to discuss the dairy provisions in there.
So much for my smooth transition. I forgot to unmute, so my apologies. The dairy provisions, so there's three things that impact dairy in this legislation. The first, Peggy already mentioned, that Farm to Family Food Box program will be initiating purchases. And so that will certainly have an impact on prices based on what happened last year. How positive that is for our Ohio dairy farmers remains to be seen. But one really interesting piece that was included in this legislation was a continued improvement of the dairy margin coverage program. And that program was initiated in the 2014 Farm Bill, where we changed from a price support system to an opportunity to ensure a margin between the all milk price and a calculated feed price. The first iteration, that dairy margin protection program, was frustrating for farmers because it was not helpful when prices were low. So some additional legislation in the 2018 Farm Bill, and then in the Bipartisan Budget Act of 2018 made some substantial changes to the program, renaming it to the Dairy Margin Coverage Program, making some more useful margins available for farmers to purchase protection for. And then finally, this legislation has added a new piece called Supplemental Coverage, and that will start with January 2021 milk production and is available through the end of the 2018 Farm Bill. So it's going to be available for farms through 2023. It's addressing one of the challenges with the original program. Since it was established in the 2014 Farm Bill, it was the first real full year's worth of coverage that was available to farms was 2015. But farms had to establish a production history, and that production history was based on the highest production of either 2011, 2012, or 2013. And if a farm participated in every year since then, there was a legislated annual increase, or they termed it bumps, to that production history that was based on the national average production for that year. So if a farm had participated from the beginning, their production history going into the 2019 program, which was what was legislated in that 2018 Farm Bill, that production history at most would be 6%, approximately 6% higher than that maximum production from those few years where that production history was established. So that can be a problem for farms that grew. This particular supplemental production program will be a favorable opportunity for farms that are eligible, and that is farms that have a production history of less than 5 million pounds. Those of you who are familiar with the program know that there's two tiers of premiums, and the most favorable premiums are available for tier 1 pounds, which is anything from 1 pound up to that 5 million pounds of annual production history. So farms that are participating, so farms that obviously have to be enrolled in the program, they have an established production history of less than 5 million pounds, they now have the opportunity to compare that production history with the actual 2019 milk marketings, and the difference between those two, up to 75% of that difference can be now enrolled in this supplemental production history program. So for instance, if a farm was at 3 million pounds and they added 1 million pounds of production, when they compared their 2019 marketings to that production history, they'd be able to cover an additional $750,000 of production history. The funding for that, it's specified that it will be funded from January 2021 through December of 2023. It does not specify an amount because it will only come into play if there are indemnities that would be payable. So if the actual margin between the all milk price and feed prices are higher than $9.50, then producers who had purchased coverage of $9.50 or less would not receive an indemnity. So it's unknown at this point what the actual cost of that might be. The other item that was included in this legislation is $400 million were allocated for the dairy donation program, and that was to facilitate the timely donation of eligible dairy products and prevent and minimize food waste. So those would be dollars available to processors who are going to donate product to a partner who would be able to distribute that product. So I will turn that over to
Barry.
Barry.
All right, thanks, Diane. I'll turn my volume up. I had to turn it down during the initial play-in music of the bluegrass. I do enjoy that. I did request smooth jazz, however, so we'll see what happens next time. All right, thanks. Thanks, David. Okay, I'm going to talk more about the Consolidated Appropriations Act, mainly because this legislation was enormous. For those that have followed it and started to try to digest some of this, Peggy and Diane have gone through some of the key features, especially as it relates to agriculture. CFAP being one of the primary pieces of that legislation that's going to be important for farm families, farm businesses. But there are a number of other pieces of that legislation that are going to be important. And I've got them bulleted here in the middle. The Paycheck Protection Program being one of the primary programs that farm families, farm businesses have taken advantage of in 2020. And some have also used the economic injury disaster loan advances, and those advances were included in the CARES Act, and many farm businesses took advantage of those as well. And also the employee retention credits, which we haven't focused on much in the earlier Farm Office lives, primarily because businesses had to have a significant decline in revenue to be eligible for those employee retention credits. And they also were disallowed if a business had a Paycheck Protection Program loan. Now, this new legislation allows those credits to be taken, and also the decline in revenue is not nearly as great as it was with the previous guidelines. So we're going to talk about these last three bullets in the next few slides here, and talk about how this new legislation has changed a lot of things and opened up a number of other things that will make more people eligible, frankly, for this Paycheck Protection Program especially. Okay, as we mentioned, this bill is enormous. It included a number of acts under the umbrella legislation, the Consolidated Appropriations Act. In total, it was $2.3 trillion, provided $900 billion in COVID-19 relief. So a lot of dollars that are going to be spent to help with relief efforts. Sorry. The legislation provides for an additional 2020 recovery rebate for individuals. Okay, stimulus checks, the stimulus dollars that are going to be flowing to individuals. And I just wanted to start with this. I know this isn't necessarily business related or even specifically farm business related, but it's going to impact all individuals, those that are eligible, and it's going to be most everyone again. And we had these appropriations, these rebate credits last year, and they amounted to $1,200 per person or $2,400 per joint return. And this year, with the new legislation, with the Consolidated Appropriations Act, it's now going to be $600 for eligible individuals or $1,200 for those filing joint returns. Plus, we have $600 in credits for each qualifying child. They did do away with the credits for those dependents that were adults, however, so that's a little bit of a change from the last stimulus payments that were paid out in 2020. And these are going to trickle out, I think, here in the next couple of weeks. I haven't received anything as far as a direct deposit in my account, and that's the way I received it last time. So I haven't received mine yet, and I'm not sure if there are others out there that have started to receive theirs, but just so we're aware, these are credits. There are phase outs for filers with higher adjusted gross incomes, and we're not going to go through all the details of this legislation and all the different details of all these individual parts, simply because we don't have enough time to get into the weeds too far with some of these programs. Just a reminder again, though, they are advance payments of a tax credit on your 2020 tax return, just like the last stimulus payments were that were paid out earlier in 2020. The same rules, same basic rules apply. If the amount received is less than the amount that you're qualified for based on your 2020 tax return. So if they don't pay you enough in those stimulus payments that are sent to you direct deposit or with some kind of a prepaid card, and some are going to receive those again. If it's not the amount that you should have received, then you're going to be able to take that additional amount on your 2020 tax return. So the same rules apply for those that receive perhaps too much. So this third bullet, if the amount received is greater than what you're entitled to, you do not have to pay the difference back. Okay, so the same general guidelines apply to these new stimulus payments, but they're less than they were last time. We don't know yet. There was some discussion about whether or not those were going to be increased, and I don't expect that, at least until we have an administration change. And even then, it may be a tough uphill battle to increase those stimulus payments beyond what they are now. Okay, we're going to spend a little time talking about the Paycheck Protection Program. Before that, I'm going to launch a poll, and I'm sorry I didn't get this included in my slides. David is much more organized, so he's going to have a slide that points out his polling question. Okay, some of you, hopefully all of you, are going to see a polling question pop up in the middle of your screen. Okay, you can answer it if you want. You don't have to. Just asking if you or a client of yours received a PPP loan in 2020. Just trying to get a feel for how much, at least in this particular group. And we have a little over 40 folks with us tonight, just so you know how many folks are joining us. But we're starting to get responses. Now, we've done a lot of these polling questions in different webinars. Sometimes there are glitches. If you have a pop-up blocker enabled, sometimes that will not allow the polling question to pop up in your screen. Sometimes it's a bandwidth issue as well. So that's why perhaps some of you aren't seeing a polling question in the middle of your screen right now. I'm going to end the polling, and I'm going to share the results with everyone so you can get an idea. There's not quite half, but there is a pretty good number of you that have gone through and received a Paycheck Protection Program loan. So a number of you haven't, and we're going to talk a little bit about how the rule changes may allow some more folks to be eligible for Paycheck Protection Program loans and the forgiveness here in the next 3 months. Okay, I'm going to stop sharing that. So it's been reopened. The new legislation reopened this until the end of March. It allows borrowers to apply for a first time or a second draw loan now. So what does that mean? Well, we're going to talk about those second draw loans here in a moment, the possibilities of getting a second PPP loan. It allocates $284 billion. So this fund is not unlimited. So there may be some issues if we do get a strong application amount. If we get a lot of folks that are applying for these loans, we may get dollars that run out. But we didn't have that last time, at least with the reallocation that we went through with some successive legislation after the CARES Act. We had more money that was attributed and allocated to additional PPP loans. But this, I guess maybe the take-home message here is to make sure that you're getting involved early and with your lender or your CPA and then your lender, whoever is helping you through this process of applying for these PPP loans. One of the big things that came out of this new legislation, and this is something that we've been waiting on since the CARES Act was signed, was whether or not we were going to have the expenses be deductible, those expenses that were paid for from the PPP loans that were either forgiven or were going to be forgiven. The IRS and the Treasury told us last year, and this was based on past case law, past tax case law, that indicated that if we had income that was not going to be claimed, the expenses that were going to be attributable to that income, that raising that income, were also not going to be able to be claimed. And therefore, we thought for most of 2020, well, for all of 2020 until the new legislation was passed and signed, that those expenses that were related to that forgiven PPP loan would not be deductible. We couldn't claim it on the Schedule F. The new CAA, the new legislation now allows it. So you get the best of both worlds, or we get the best of both worlds if we have a PPP loan. We don't have to claim the income that is forgiven loan. We don't have to claim that income. And we can also at the same time deduct all of those expenses that were related to that forgiven loan. So that the new legislation gave us what we had expected for many months. Many of our legislators had indicated and kept pointing to the fact that that was not the intent of the original legislation. And now we finally got to the point where we have the intent as what originally was supposed to be with the CARES Act. Okay. Qualified self-employed farmers. And this was another point here included in this new legislation that's really going to be impactful for a lot of farmers, a lot of farm business owners that didn't apply and didn't receive a PPP loan first time around, primarily because they didn't have enough net income in 2020 or 2019. So if we didn't have $100,000 of net income in 2019, we weren't eligible for the full amount of that forgiveness. The new legislation now changes those guidelines, changes those rules for farmers to allow you to apply for these PPP loans based on gross income rather than net income. So this opens the door to a lot more producers to either get their first loan or get a second loan. And I'll explain those guidelines here in a moment. Farmers are now able to receive a PPP loan of up to $20,833 according to the calculations. And that's without an employee. If they have employees, then that allocation or that loan could be higher, and based on the gross income of at least $100,000. So if you haven't applied, or if net income was the primary reason why you weren't able to max out the PPP loan forgiveness in 2020, you now have the ability to do that and also receive a second loan. So let's talk about that. Here are some of the different options that you have as a small business owner, or in this case, this is specifically for farm business owners. The gross income issue is specific to farmers. So the Economic Aid Act provides a new loan calculation for self-employed farmers based upon gross Schedule F income, rather than that net Schedule F income that we had talked about So the new calculation, we can now apply if you didn't apply before, or if you had clients that didn't apply before, you can apply for that first draw loan. Or if you haven't been granted forgiveness, you can ask for that loan to be refigured and maximized up to the point where you have gross income that will allow you to. So as long as you have $100,000 in gross income, you can also get that maximum amount of loan forgiveness. So you can request an increase with the lending institution that you may have worked with, as long as the forgiveness has not been received for that particular loan. Once it has, you're out of luck. There's no going back on that. Okay, and then we can also request now a second draw loan based on the new legislation if we're otherwise eligible, and we'll go through that eligibility here in a moment. We can also spend proceeds on, well, basically the proceeds can be spent on what was indicated in the CARES Act, and also an additional set of covered expenses that are listed here at the bottom of this slide. We have to remember, however, if we want full forgiveness, we have to spend at least 60% of that particular PPP loan on payroll. And it can be it can be owner compensation, which for those farmers that applied and didn't have employees, for owner compensation, then the entire amount effectively is towards payroll. But if we have farm business owners that applied, received a PPP loan, and based on a set of employees, then we have to be a little bit careful to be able to be granted full forgiveness that we're using at least 60% of that on payroll. The rest can be used on any of these other types of expenses that are listed. And this new legislation opens up a number of other types of expenses that we can spend that loan on, including PPP, worker protection expenditures, personal protective equipment down here at the bottom, a number of things, and I'm not going to go through all those. Okay, just to reiterate what I had already talked about earlier, the IRS and the Treasury indicated that the expenses covered by PPP loans that were forgiven or would be forgiven would not be deductible. And just to reiterate that now, this new legislation now allows those expenses to be deducted. We have more flexibility now. We can choose anywhere from an 8 to 24 week covered period. And what this may allow theoretically for those producers that didn't apply for a PPP loan in 2020, depending on who you're working with in terms of a lender, we don't know all the guidelines. Theoretically, a producer could apply for and receive PPP loan 1 and get the payment, and also go through the process of forgiveness and then apply for PPP 2, the second draw. I'm not sure how the Small Business Administration is going to look at that, but theoretically that could happen, where even if you haven't received the first PPP loan, you could go through the PPP loan once and then twice, assuming that you're going to be covering all or going through the covered period. You're going to have to select a shorter covered period in that case for that first loan, but we have that flexibility anywhere from 8 to 24 weeks. We also have a new guideline in the new legislation. What we had before is that if we received any kind of an idle advance, and we could receive up to $1,000 per employee, and we could also include $1,000 for our own self-employed person. If we received an idle advance, previous rules would have had to have us decrease our PPP forgiveness by that idle advance. So if we've received an idle advance of $2,000, for example, we would have had to have decreased our PPP forgiveness, that portion of that loan, by $2,000. So in other words, we would have had to have paid back part of that PPP loan based on that idle advance. Now we don't have to do that. The new loan or the new legislation now gets rid of that particular guideline. So we can receive that idle advance. That's going to be tax-free. The PPP loan that's forgiven, tax-free, and we can claim all the expenses that may have been have been paid for from both of those particular loans. Okay, the second draw. Now this new legislation gives us an opportunity to get a second PPP loan. They're calling these second draw loans. Most of the same general conditions apply as PPP loan number one. So if you received one in 2020 and had forgiveness granted or will have forgiveness granted, you can apply for the second draw loan, another PPP loan, under most of the same guidelines. Okay, so as long as you used that PPP loan version or number one for all the allowable proceeds or all the allowable expenses, you are going to be eligible for PPP 2. There are, however, a couple of stipulations. There are a couple of additional guidelines with PPP second draw loans. First of all, and it's not going to affect any of us or most of us, you have to have less than 300 employees. The second guideline is going to be a little bit more problematic for some, and it's just a gross receipts test. You're going to have and take a look at all of 2020, and you are going to have 25% lower gross receipts in one of the quarters compared to where you were in 2019, or you can compare the entire year. So we can go back and look at the first quarter of 2020 compared to the first quarter of 2019. If that was 25% lower in terms of gross receipts, then that will trigger our eligibility for PPP 2. Or we can look at the entire year. I know I talked to one producer today they were going to look at their commercial activity tax returns where they're going to be paying quarterly. So they could have taken a look at that and seen pretty quickly in terms of whether or not they were going to have gross receipts change from 2019 to 2020, 25% lower in any quarter for the entire year. That's going to allow you to be eligible for the PPP second draw loans. Now, you'll notice that the terminology that we're using here is a little bit different. Gross receipts is not the same as gross income. Gross receipts, what we think, at least, and how we're interpreting this is going to include all your business income. So Schedule F income from 4797 sale of business property, and there's also going to be a cost of goods sold that are going to be deducted from this calculation of gross receipts. But we're not going to go through all those different calculations here this evening. If you want those, we can direct you to sites that are going to allow you to really dig in deep and start to figure out whether or not you're going to have those gross receipts change, a decrease of 25%. But again, you just have to find one quarter in 2020 that was 25% lower than 2019. May not work out for some, but for some producers, it will. Okay, borrowers that have not yet received forgiveness. I mentioned earlier, if you haven't received that first PPP loan, you can apply for one now. Or if you didn't maximize that PPP loan request initially based on your net income, you can go back to your lender and work with them to go through that process to increase that PPP loan to the maximum allowable based on your gross income now. The other thing that came out, and this is going to give relief to a lot of people, if your PPP loan was less than $150,000, there's simplified forgiveness procedures now. However, you're going to have to retain those records you can see what's on the screen there, 4 years for employment records, 3 years for other records, just so in case you were to get audited by the Small Business Administration at some point. I think the likelihood is pretty low, especially for these lesser PPP loans, anything less than $150,000. But you will be required to hold on to those records in the event that you would. The legislation, okay, we're going to switch gears here now. We're going to talk about a little bit about the employee retention credit. And this is going to be something that some producers may be eligible for now, based on the fact that the decline in revenue is that particular test to be eligible for this employee retention credit is much less than it was under the CARES Act and the subsequent legislation before the Consolidated Appropriations Act. Okay, so the legislation extends and expands the employee retention credit, allows producers to remain eligible up until the middle of this year. If you received a PPP loan previously, and I mentioned this at the beginning, you could have one or the other. You couldn't have a PPP loan and also be eligible for the employee retention credit. The new legislation now allows us to have both. However, there's the stipulation at the bottom, as long as the qualified wages, to the extent that the wages were not paid for with the forgiven PPP loan proceeds. So we couldn't pay for those wages with the PPP loan that's subsequently forgiven and then turn around and also claim the employee retention credit on those same wages. They had to be a different subset of wages, if you will, or they will have to be for the next 2 quarters. Okay, the one big thing, and there are 2 big things, I guess. First of all, the employee retention credit increased from 50% of qualified wages to 70%. So a pretty significant increase in terms of the credit itself. All right, and then also you can claim that up to $10,000 per employee per quarter, those eligible wages, instead of for all quarters. So in 2020, if you were applying for or you're using the employee retention credit, you only had $10,000 per employee for the entire period of 2020. If you're going to use this particular credit for 2021, you can use it up to $10,000 per employee per quarter. So there's 2 quarters left in eligible up to July 1st, 2021. The other thing is, and this is the point that I want to, I guess, emphasize, is that we don't any longer have to have gross receipts decline of 50%. That was a pretty high hurdle to get over for most businesses. You had to have a really steep decline in gross receipts from 2019 to 2020. Now we have to show only an 20% decline. So if we have anything less than 80% of gross receipts from 2019 to 2021, the 2 quarters in 2021, we can trigger our eligibility for the employee retention credit. Okay. There's some more here on the economic injury disaster assistance. I mentioned this already before, those advances that some people were able to get, those economic injury disaster assistance advances for $1,000 per employee. Just want to reiterate that income is not taxable, and we can take those expenses for anything paid for from those advances. Net operating loans, and we had a little bit of a setback with the CARES Act. We were a little bit limited in terms of how farmers might be able to claim net operating losses. With this new legislation, however, we now have a little bit more flexibility. We can now use either a 2 or a 5-year net operating loss carryback. There are some exceptions to that, but generally most farmers will have the ability to do either a 2 or a 5-year carryback of net operating losses. So that may give some flexibility. Well, it does give some flexibility to tax returns. One thing that we had talked about in some of our tax schools is this discussion right here. And we weren't sure if this was eventually going to be included in the new legislation, but they did. It included this. We were a little bit surprised, but the new legislation allows for 100% deduction for business meals, as long as those business meals qualify. And farmers, farm business owners, if you're providing meals to employees and it's during a period of time of year where essentially you're doing it for convenience purposes for the business, so you can continue to work in those really those busy times of year, then you're going to be able to qualify for those. It's 100% deduction, and one of the caveats is that it has to be paid for, or it has to be provided from a restaurant. So in addition to providing a little bit of a bump for businesses, it also provides a bump for restaurants as well. Not that restaurants aren't businesses, but you get the point, I think. Okay, and I think that brings me to the end of my discussion, at least the first one. And I'll be back here in a little bit to talk more about some other outlook issues. So, all right, folks, thanks for sticking with us. I know that's some more of the heavy stuff that we'll talk about here this evening, but there is going to be a lot of the new legislation that's going to be meaningful to some of your clients or to some of you personally.
And I think, Barry, as everyone sees here, there's just a lot wrapped in with that Consolidated Appropriations Act. So there'll be plenty that we're talking about tonight, but plenty as we move into February, even into March, that we'll know more as we start to dig deep into the thousands and thousands of pages of what was in that act that was passed there at the end of 2020. So with that, we would like to continue the theme on tax issues. And because here in 18 days, some farmers may not realize that they have some things to do differently. So to kick off for first is I want to talk about reporting income. Barry asked if I could just share about reporting some of the income that we might be receiving as farmers that will be eligible for our tax return this year. And then to talk about the big change, a change that we have to go back to 1982 to go back to the last time it was changed when we talk about non-employee compensation. So the first, just as far as income, can it be deferred? Lots of questions at the end of the year. Can I defer this? Am I allowed to defer it to the next tax season or not? And just we thought we'd throw a table here together just to walk you through this. Farm bill programs first. There were some farm bill program payments paid for ARC and PLC. I know Chris and Mary are on here, and they had an excellent ARC and PLC planning farm bill program earlier today. But we did receive some payments from that 2019 year in 2020. So those are claimed, the ARC and PLC, also the WIP, which is you would be kind of weird. Why did any producers receive a wildlife and hurricane indemnity program plus payment? And actually we were eligible under WIP 2. So some of the losses that occurred in 2018. So those program payments that you received in 2020 have to be claimed in the year they received. So they were received in 2020, they're going to show up on your tax return. We also had some of our producers, of course, maybe have received an EQIP, an Environmental Quality Incentives Program payment. Of course, those are taxable in the year received. I mentioned CFAP. CFAP 3 is coming. Of course, we saw versions 1 and 2 of CFAP, of the Coronavirus Food Assistance Program, that were payments that were made. Now, again, these are disaster payments, so kind of look at those similar to crop insurance. For that reason, some people have asked, well, can we defer them like we might on crop insurance? Well, there's one clear pointing to the answer of no. Because the proceeds that are related to damage can be deferred, but not proceeds that are received based on price. And the CFAP payments were based on price-related movements. So therefore, they should be treated like our other ag program payments, like ARC and PLC. Those are going to be taxed in the year that they were received. And I don't believe that many folks received maybe a prevented plant payment, but in case you did, they can be deferred if you have that history in your farm of deferring or of selling 50% of your crop or more in the year after. So you could defer it if your traditional method is to sell that crop, the corn and soybeans, over 50% in that next year. And then the same rule kind of applies, and there's been guidance, a lot more guidance in the last couple of years about revenue insurance. And we have revenue insurance policies. Again, we go back to the proceeds that are attributed to the loss or damage to the crops. Those are eligible to be deferred again. But if it was because of a price movement, then that part that is subject to the payment subject to the payment of the price is not deferred. So just a quick just a summary of some of the income that you might be receiving on farms and how you'd be handling it. Now, Barry, I think you can help me out here on a polling question, and I don't know if that will pop up. So the question we have is, are you aware of IRS change of reporting non-employee compensation from the 1099 miscellaneous to the 1099 NEC? I know if anybody who was at the tax schools that Barry put on, would know the answer to this. And Barry, the votes are coming in here. We use these poll questions to get you up and get you moving, so I don't have to play any of that music that we were playing beforehand. It looks like close to everyone, 75% of the people have voted. So you want to go ahead and share those results. And the results were that 61% said no, that you weren't aware of this change. Well, in 5 minutes, we hope that you are well aware of the changes that were made. So we can stop sharing that. And this is the old form. We'll move through. If I could, there we go. There's the 2019 miscellaneous. Previously, if you had a non-employee compensation, that was reported on 1099 miscellaneous. That was in box 7. As we move to the next slide, here is they have separated that form. So that form, now the compensation is listed on its own form, which is the 1099 NEC for the non-employee compensation. And just as a part of history here, that form used to exist back in 1982 when they discounted it and brought it and combined it all on the 1099 miscellaneous. Now, the reason that they made this change was the PATH Act of 2015 accelerated the due date for filing 1099 forms that included any non-employee compensation. So what happened was the form, if you were using a 1099 miscellaneous, if you had non-employee compensation on it, it was due at the end of January. If you were using it for miscellaneous, the other parts of the miscellaneous form, it was due at the end of February. So they've tried to decouple those so it makes it easier to be reporting those. And there's the 1982 form for those that might have some gray in your hair. You might remember the 1982 non-employee compensation form. And Diane's even shaking her head. No, she doesn't even remember it. But it was back there in 1982. Of course, just as a reminder when to report a 1099 non-employee compensation. And here's the 4 conditions that if they're met, then you must generally report a payment for non-employee compensation. It boils down to, are you making a payment to someone who is not your employee? Are you making payment for services in the course of your trade or business like your farm? And are you making that payment to an individual, partnership, a state, and in some cases a corporation that could be like your attorney? And did you make payments to the payee at least $600? Now, you could make the payment less than $600 and you could still send a 1099 NEC, but that is not common practice. It's when you hit the $600 level and above. Now, for agriculture, usually the examples that we think of non-employee compensation, that could include hiring your neighbor to harvest, spray, or plant your crops, or maybe some independent contractors like crop consultants, mechanics, accountants, and veterinarians. Just remember that payment for parts and materials that you use to perform the service is included in non-employee compensation. For instance, I hire someone to do some work on a tractor. Now, if they go out and they buy all the parts, all the things that they need to fix that tractor, and they include that in the bill to you, just know that when you fill out the 1099 NEC, that all rolls into the amount that you would report on the 1099 NEC. And then if it's an unincorporated business in the excess of $600, now pretty important to have people fill out the W-9 so you can actually know ahead of time what type of business that they are. The LLCs who are reporting as sole proprietors, that's where you'd send them to. And the big note to know, and you have 18 days to do this, you have to furnish the statement to the recipient. This is where it's completely different than our 1099 miscellaneous. You need to furnish that statement to the recipient and to the IRS by January 31st. So 18 days from now, those are all due. Now, they have altered the 1099 miscellaneous. So there's just a screenshot of the new 1099 miscellaneous. Basically, they have taken the non-employee compensation off of the form. Now, just as a reminder, again, the 1099 miscellaneous is still used. We still will use it much like we have done in the past. For instance, for the farming side, that means if at least $600 in rent, that's on box 1. If there were crop insurance proceeds, that would be on box 9. So the 1099 miscellaneous still essentially is the same form that we've seen in the past. And again, the only difference here is just like it was in the past, it is due to the 1099 miscellaneous person, to that business, by January 31st. So again, just like the 1099 NEC, you're required to give that form to the person by the end of January 31st. The difference on the 1099 miscellaneous is that you don't have to file it with the IRS until the end of February, if that is a mail-in form, or if you're doing an e-filing, you don't have to have that form to the IRS until the end of March. So basically that allows you to have some reconciliation time. If there's a mistake on it, it gives you that 30-day window to make those corrections if you have to. Now, we have been asked in past programs, and this is one of the most common, what happens if the contractor will not complete a W-9? And they won't fill out the information form so that you have it. And the rules is you look at the guidance, and I'm going to give you some links here. As far as the guidance on that is to withhold the 28%. And that's the withholding the 28%. And you'll see on the 1099 NEC, there is a box on that that allows you to show the withholding that you withheld, and you're supposed to send that into the IRS. You can mark refused on the 1099. And don't you love it when the dog just barks? You know, when someone comes in, a burglar must be here stealing everything upstairs. And just to know that the Form 1099 NEC has already been tweaked for 2021. So they continue to evolve, and they've made corrections with as far as the direct sales comment there in box 2. So that box 2, if you were to compare the 2021 form to the 2020 form, box 2 is blank on this year's, but you'll see it as we roll into 2021 that they've added the payer made direct sales totaling $5,000 or more. There are some links for you, again, for further guidance for the Form 1099 NEC and the 1099 miscellaneous. Just to know, you have 18 days to get those NEC forms sent out. And I know Diane reported she already asked the IRS for paper copies, and Diane already received those in the mail. So you still have the ability to get those paper copies. You also have the ability to file those 1099 NECs electronically on the IRS webpage. Let's look for how you would just do a search once you get on there for the FIRE system to be able to upload those electronically. So you can do that. Okay, Barry, that's all I have on the 1099 NECs if you want to grab control back.
Got it, David. Thank you. A lot of good information there. I'm going to be efficient here. We're going to look at a couple of different things, crop budgets, look at the outlook for this 2021 period. And then we'll take a look and see what may happen with land values and also rental rates. I think it's important that we start, and this is a very busy slide, I know. Look at the right-hand graph. This is the USDA estimates for net farm income for the entire US, what's circled over here. And this is as of December 2nd. So even this number is probably going to end up being a little bit higher when it's all said and done, primarily because prices continued to go higher throughout the month of December. So this number, you know, after we were kind of a little bit concerned there at the beginning of 2020, net farm income total came out pretty well. Now, there were some sectors that didn't have nearly as good of a year as others. But I want to point this out and compare that to what we were looking at earlier in the year. We go back here, and this is the USDA estimate, this particular graph here as of September. So you can see the differences. Their expectations for US farm income was a lot lower than it ended up being in December. And then this is all the way back to their estimates in February of 2020. And you can see that they were expecting net farm income to be essentially flat and net cash farm income to be much lower. So along the way, a lot of things changed in 2020 to get us to where we were in towards the end of the year. And some of that had to do with higher prices. Some of that had to do with a pretty large infusion of government payments, ad hoc government payments. So we look forward into 2021. Our crop budgets are downloadable Excel spreadsheets that people can use if they so choose. But I want to look at where we are, at least right now, looking forward into the 2021 harvest period. And when we're all said and done, what is our bottom line likely to look like for corn, soybeans, and wheat? You can see I've got some things circled. This is the trend yield for Ohio, 20-year trend yield, so around 175 bushels. And we're looking right now at about a harvest price, a cash price that we can lock in of around 4.25. What does that give us here at the bottom? Well, the numbers look a lot better than they did at the beginning of August, right? When we had prices that had continued to trend lower through parts of the summer, at least. Returns to variable costs down here for that trend line corn yield is around $340. Returns to land looking a lot better than it was a couple of months ago, right around $170 an acre. We go to soybeans, this picture looks even better. You know, the USDA reports came out today and yesterday, and additional bullish information. They revised the corn yield down significantly. We had more usage, and our stocks continue to trend lower, both corn and soybeans. You can see if trend line soybeans of 54 bushel, and we can lock in about 1140, even higher in some areas per bushel for soybeans for this next fall delivery. Returns to variable cost over $400 an acre, and returns to land 280. And that's not even our high yield scenarios that we'll look at here in a moment. Wheat, if we go next to wheat, you know, of course, that decision's been made for the most part. 72 bushel wheat, 6.25 for next summer delivery, and we can lock that in pretty much for next summer delivery right now. And you can see that these numbers look very good, and these don't include any straw or double crop returns. If we look at the comparisons, and these are the trend line yields for each of the three crops looking forward in 2021. And we know our costs aren't going to be your cost structure, so you're going to have some different costs, but these are the costs that we have built into our budgets that for the typical Ohio farm. We're not now putting in any ARC PLC payments. Need to tweak this a little bit, and I'm not including any ad hoc government payments. We don't know yet what's going to happen. We may have some additional ones to include for that 2021 crop. I'm not sure where you put CFAP 3.0. Do we include that in the 2020 crop returns, or do we lump that into the 2021 crop yet to be planted? I didn't include it. So we look down here as returns to land, and we look at across the board corn, soybeans, and wheat. As you might expect, with the sharp run up in soybean prices over the last few months, soybeans continues to paint a little bit better picture as we look forward into 2021. And I think we're going to see probably plantings throughout the U.S. show that, as long as these price relationships hold. If we look at the higher yielding scenarios, these are the trend yields for Ohio. If we look at the higher yielding scenarios, so 210 bushel corn, 65 beans, 86 wheat, you know, some of the corn starts to catch up a bit, but we can still see that soybeans has a distinct advantage over the other two in terms of returns going into 2021, assuming these prices hold too, of course. But that's the outlook right now in terms of profit margins, including costs and returns. So not a bad picture, especially as we look backwards to where we were perhaps expecting things to be in the summer. Taking a look at farmland and rental rates real quick, you know, these go hand in hand a little bit, well, mostly with the return outlook that we're expecting for crops for 2021. And most everything is in this left-hand column. Most of the fundamentals are very supportive of land values and also rents that we'll talk about in a moment. Farm income, at least the USDA analysis at the beginning of December, is showing about a 43% increase in farm income in 2020 over 2019. So a lot of that has to do with CFAP payments. Farmer equity positions, they remain relatively healthy, even though we have seen some erosion in equity in the entire U.S. farm sector. But I expect that likely to start to turn here in 2021 with higher government payments this past year and higher crop prices this upcoming year, at least expected. Margins improved, interest rates still continuing to be a very strong fundamental for any asset values and land values in this particular instance. So these lower interest rates will provide support. ARC PLC payments in 20, there were some, so that's going to be supportive. CFAP 1.0 and 2.0, very supportive. And in some cases, we may have to start worrying a bit about whether or not we are going to see a little bit of a bubble in some of these asset values, especially in land values, as we had a pretty big infusion of dollars coming into the sector. And whether or not those are sustainable, my guess is no. Land supply continues to be relatively low coming onto the market. Estate taxes are essentially a non-issue. So farms that have even fairly large land holdings don't typically have to worry about liquidating any of that upon the transferal of that to escape estate taxes. Phosphorus regs in certain parts of the state, it's a little bit of a unique issue in Ohio, continues to put pressure in some parts of the state as some of the livestock producers are searching for more land and will bid higher values for some of that land just to have enough area to dispose of livestock waste, livestock nutrients, I should say. And we have in Ohio, we're one of those fringe states. We have large populations, and development pressure continues to put some additional pressure on farmland value markets in those fringe areas, those areas in and around those large metros areas. Okay, suppressive fundamentals, those issues that may put a lid on these farmland values. We're not going to likely have ARC PLC payments this upcoming fall. This when we get to October, based on the 2020 crop and prices. Time will tell, but it's likely we're not going to have much. No ad hoc payments. I've got a question mark there. Your guess is as good as mine, but I would expect those to be much less in 2021. Farmer equity possessions are weakening, and then livestock and dairy income is mixed. I mentioned earlier that the prospects for these crop producers with crop budgets looks pretty good, but on the flip side, livestock producers have to pay for feed, and as these prices work their way up, Diane can attest to how the feed bill starts to increase for dairy producers and everyone else that's has to buy feed. So I think overall, as we look at this entire picture, I think in what we've started to see show up in some of the recent auctions, even this fall, was some upward pressure on land values. And I think we're going to see that throughout Ohio, even with the way we were positioned earlier this last year. We weren't expecting things to be quite as good as what they ended up. Government payments have certainly helped, but this increase in crop prices has certainly helped as well. Similar fundamentals with rental rates. I would expect to see upward pressure on rental rates, and I don't expect that to abate even throughout most of 2021 with these higher crop prices on the heels of these fairly high and significant government payments. The one thing that continues to offer some relief is that CAUV values, property taxes that relates to CAUV values continues to trend lower. So that's going to be at least somewhat of a relief, but I don't expect that to dominate the headlines as farmers start to negotiate with their landlords for this next year. So expectation, again, following land values, rental rates, upward pressure, there'll be some areas that they'll be fairly flat, but I would expect to see somewhere between 2, 4, 5% upward increases or increases in both rents and land values. And in some areas, I expect those land values perhaps to see even a bigger jump, at least for this year. Okay, just want to mention that the farm custom rates, we have this survey summary completed, and if you haven't already accessed that, you can get that through the Farm Office website. We're doing this every couple of years, so that's available now, and the new numbers are there. So with that, I'm going to stop and turn it back over to Peggy, I believe.
Caught me off guard there, Barry. I thought you would take a little longer on that.
Well, I think I took more than my time on the first set, so I tried to make up for that on this second set.
Okay. Well, I'm going to talk with you about some current legislation that went through the Ohio General Assembly. So taking a switch here now from some of the federal laws and policies we've been dealing with, and look at what happened downtown at the State House, looking at those late session bills that went through. There were some I had hoped would go through and they did not. I'm not sure I'll ever get my purple paint legislation. It's been up now 3 sessions in a row, and for some reason they can't seem to pass that one. But we have been writing about legislation that has gone through here recently, and you'll see a post here on the Ohio Ag Law blog on farmoffice.osu.edu. You can sign up to receive those posts if you'd like, or you can go back and refer to those. As I mentioned, a few important pieces here. The first one that I have noted there that is on the blog page that you see is HB 7, the water quality bill. And that bill took a while. We thought it would go much earlier than it did, but it finally got through at the end of the 2-year session. And it creates some additional support for Governor DeWine's H2 Ohio program, including watershed planning and management program, along with a certification program for farmers who institute best practices. So we'll be seeing those regulations coming out of ODA for how that certification program will function. We also have some funding that ODA has now been authorized to use for additional purchases like equipment, soil testing, NMP implementation. And speaking of that, a question that I often receive in regards to nutrient management plans is whether those are subject to the public record requests. And this legislation included a provision saying, no, they are no longer subject to those. They can be exempt from public records requests, and that should provide yet another incentive for producers to engage in those nutrient management plans. We also had in this package a little side issue added in that gave CAUV eligibility for biofuel production on those lands where those facilities take place and exist. So that all came in House Bill 7. And then one of my favorite bills came in the form of House Bill 340, which was the petition ditch laws. I've been on a task force that worked on this bill for 6 years, and we completely revised the petition bill or the petition ditch chapters of the Ohio Revised Code. There are 4 separate chapters. And so I can't tell you about all of that, and I'm not sure you'd want to hear about all of that, but I can tell you that some of the major changes that we made in that piece of legislation is to streamline those different processes that we have when it comes to petition ditches, and you can go through the county engineer or the Soil and Water Conservation District. We now have streamlined those and mirrored those so that they look very similar regardless of which route you choose. There are very similar requirements for filing the petition, for the notice periods, for the hearings, all very, very similar. That created a lot of confusion around the state. We also dealt with some clarifications that were necessary when we have ditches that go beyond a single county into multi-county projects. And then a big one that many need to be aware of is that the sod or seeded strips that will now be placed on a drainage improvement project will be 10 to 15 feet wide rather than the 4 to 15 feet that is in the current law. And all of that acreage is to be removed from taxable value for property tax purposes. So be aware of that. And then we also propose some changes to the determination of assessments and included specific guidance that are to be made when examining those factors that play into determining the amount of that assessment. And you can read more about this. I'll be posting a blog post here soon that gives more details about that, along with many of the other provisions in those 4 chapters that we changed. That was a major accomplishment, and I applaud Representative Cupp, now a Speaker of the House, for getting that through for us. Another one I want you to take note of is the new Ohio Revised Limited Liability Company Act. Now, this one won't actually take effect until next January, so that allows time for us to sort through it. It's a pretty significant change, complete revision of our LLC chapter of the Ohio Revised Code. And it also will give some time then to do some planning accordingly before it actually takes place next January. But the most important changes here is that it eliminates the distinctions that the current law holds between whether an LLC is managed by members or whether it's managed by a manager. And that has caused a lot of confusion over the authority, who has what authority. And now we are we will be next January replacing that kind of the differences between those two with one consistent way of determining authority within an LLC. And that can be determined by the operating agreement itself, or if not, there are now going to be default rules in the Ohio Revised Code that clarify authority to act on behalf of the LLC and will remove that strange distinction we had between member versus manager managed. There are also statutory rules that will come into play as default rules regarding fiduciary duties and the standards of conduct for both members and managers in an LLC. And probably the biggest change that many may feel come from this legislation is that it authorizes series LLCs. Now, this won't be applicable to many industries, but I see this working well for agriculture, because we do have many farms that end up having multiple LLCs. So the new series LLC authorization will allow one filing for an LLC, and then you can claim series that are based on separate series of assets within or under that parent LLC. As long as there's common ownership of those assets, they all are filed under that parent LLC. So that removes some of the burdens of having to file multiple LLCs. Now, you'll be perhaps disappointed to know that it doesn't remove the record keeping requirements for those different series of assets, but the parent company is one filing, one LLC, and then we do separate operating agreements and records for those series that are within that LLC. And then last, I want to alert you to the new B Corp law. This is one that I was a little surprised to see because it's come up several times over the last few years, since about 2016 or so, and has not passed, but it did pass this time, and it will be effective in March. It allows B corporations in Ohio. What a B corporation is, a beneficial corporation, basically. So a for-profit corporation can now form for the purpose of providing beneficial purposes within its formation purposes. An existing corporation can amend its bylaws to include those beneficial purposes as well. So beneficial purposes, what does that mean? Well, there's a definition in the law that says it's a purpose of trying to have a positive effect or removing or reducing a negative effect in regards to artistic, charitable, cultural, economic, educational, environmental, literary, medical, religious, scientific, or technological issues. So if you have kind of a social agenda within your corporation, that can now be formally be part of your corporation. And that's important because that then allows that corporation to bring in investors who want some assurance that you are operating in a certain way, or that you do have these social goals within your corporation. It also, the legislation protects the directors of that B Corp from liability for, let's say, the beneficiaries of those beneficial purposes. So there's no liability to those potential beneficiaries. And also they may include those beneficial purposes in determining what is in the best interest of the corporation. So the goal here basically is to encourage more investors in Ohio businesses who are seeking or who have that similar goal of addressing some of these beneficial purposes for what we would call social issues. So that's a good one to watch, and we'll see what happens with that if any of our businesses are interested in amending or forming as a B Corp. Okay, so that was a quick run through. Feel free to ask me if you have any questions, and let's see, I'm throwing it back over to Diane now, correct?
Correct. So as we wrap up tonight, and there's been a huge amount of information that we've covered, I did want to take the opportunity to remind you that it is farm business analysis season. As farmers close their books for the 2020 production year, this is the time that we want to move right into farm business analysis. That is available for really any type of farm in Ohio, and farmers have an opportunity to do two types of analysis. This whole farm analysis gives an accrual adjusted analysis of the production year. So that means we're pulling all the income, all the expenses into that production year. And I'm going too fast. With that analysis, a farm gets their balance sheets, an accrual adjusted income statement, a cash flow statement, statement of net worth, and calculates for them the farm financial standards, both numerical reports as well as graphic reports. And for farms that have been enrolled for multiple years, they get that laid out historically as well. So that opportunity to see not only how this year was, but where am I trending in terms of, are things getting better? Are there some red flags that I need to look at? Farms that do just whole farm analysis, typically the first questions they have are, how can I do things better? How can I improve my profitability? And so doing this second step of enterprise analysis is, I think, a really important benefit of participating in this program. And that's where we get those costs of production for enterprises, both crop and livestock enterprises. And then farms who participate get personalized benchmark reports where their performance is compared to that of the other farms in Ohio. So farms that are raising crops in the same conditions, crops, livestock, whichever. And then there are annual summaries available that any farm or consultant can use to see what those numbers look like for Ohio. We have a great team that's out there to help do farm business analysis. We have this great group. They're located around Ohio. We run the program out of the Mahoning County office, and we have technicians that are home-based in those counties that you see highlighted in green. What that does not mean is that they can only work in those counties. Those technicians are available to work with farms across Ohio, and they do. This year, analysis is still available for a ridiculously low price of $100 a farm because we are supported by a grant. The USDA NIFA has a grant program, and we are in a group grant with the Northern Plains Regional Farm Business Management. and benchmarking project, and that allows us to offer it. And this will probably be the last year that it is offered for just $100, but a great opportunity for farms to get started. And basically the information that farms have to provide is everything they'd provide their tax preparer, and then to do farm business, to do the enterprise analysis, then we need to break down some of that income and expenses by enterprise, of course. But so much of the information they compile for their tax preparation and for reporting if they're participating in Farm Service Agency programs is the basic information that they need for this. So definitely would encourage you or your clients to participate in that. You can contact those technicians directly or myself for more information about the program. But our objective is that we will be complete with those individual farm analyses no later than the end of May, and much sooner if the farm is able to provide that information, and they'll get their information at that time for their individual farm. And then those benchmark reports for 2020 will be available no later than July.
Thanks, Diane. Well, that's 90 minutes packed full, and we knew it would be based on being a couple months since we've been here live with you on the Farm Office program. Before we close, I just want to share a couple other opportunities with you just as reminders. And if you are stepping away now, we just encourage you to do the evaluation on your way out. But just remember the ARC PLC, there was a Farm Bill program that was held earlier today. But there are two other opportunities for you to learn more about the ARC and PLC Farm Bill program. Next one's going to be February 25th, 9 to 11 a.m. And there's also a corn and soybean crop insurance considerations program on March 8th. And you can go to go.osu.edu/ARC-PLC 2021 to register for that program. Also a reminder that AEDE and OSU Extension are having some winter outlook meetings, and Aaron Wilson will be joining up with Ben Brown, and I think many of you know Ben has gone back to Missouri, but he's still doing some programs for us for this winter, and you can see on your screen there that they'll be doing a climate and a grain outlook there in January, February, and March. And finally, we're always thinking about estate planning and transferring your farm business to the next generation. The Planning for the Future of Your Farm webinar series is going to be held on February 15th, 22nd, and March 1st in the evening, 2 hours each evening. And to reserve your spot in that, there's a $40 registration fee, but we're inviting the entire family to be part of that, regardless of where you live. Just go to go.osu.edu/farm succession. And finally, a reminder on our next Farm Office, if you want to refresh what you just heard tonight, just join us back here on Friday from 10 to 11:30 a.m. And if not, we will hopefully see you on either February 10th or the 12th. And we're doing 2 sessions each month. So we hope that you will sign up for those programs, and you can register again at the go.osu.edu/farm office live. And I'm going to stop my share for one last moment, bring us all back together. And panelists, I don't know if there's anything that any of you have for closing comments, and if there's any Q&A and chats, we'll clean those up before we close the meeting. I'm happy to put some more music on for you, Barry, but not so cool jazz. I have it queued, ready to go. I'm just letting you know.
Next time, just try to have a little more variety. Beverly Hillbillies played twice back to back, so I was a little disappointed in that. But,
you can't beat Jed Clampett, right? So
I suppose. Thanks everyone for joining us, and we hope to see you back again. But we appreciate your attendance and your partnership.
Can you hear that, Barry?
No.
I can. That's why I'm smiling.
Yes, and please.